Well, over the past few years, firms experiencing a cash crunch often turn to sovereign wealth funds for help because they were an easy source of cash in many ways. But our next guest says that sovereign wealth funds, particularly in the Gulf region, are now feeling the cash pinch. And that could really change the playing field for many of the firms. We saw it with Citi just over the past 2 weeks as the Kuwait Investment Authority sold its stake, and we saw Abu Dhabi try to shy away from the stake it had promised to buy in Citigroup as well. So this really does matter for the market. So to tell us about the health of global sovereign wealth funds and which are poised to emerge sources of liquidity in 2010 is Jan Randolph. He's head of sovereign risk at IHS Global Insight. Jan, good morning to you. What has changed the picture here the most for sovereign wealth funds?
Well, I think, first of all, sovereign wealth funds are very closely connected to these so-called global imbalances, whether surpluses or deficits, and they've all been pinched under the great global recession we're just coming out of. It hit the Middle East particularly hard, with the oil prices down, oil demand volumes down. Many of these surpluses in the Middle Eastern countries have virtually disappeared. So, the essential cash flow funding these sovereign wealth funds has virtually dried up for many of them, but not all. There are some super surplus exporters that still maintain that surplus: Kuwait, Libya, Abu Dhabi, and Qatar. These are still fueling some of the sovereign wealth funds there. But in general, many of them have been focused at home. They've had to deal with their domestic problems. They have their own credit crunch issues. We've seen Dubai. They've been tasked by their owners, the governments, to look at issues back at home.
Well, it was often the case, or it became almost an anecdote that people would jokingly refer to here in the investment community, that when you really needed cash, you got on a plane, you flew to the Middle East, you packed up your suitcase, and you solved your problem in the short term. That's not necessarily there based on what you are saying. I mean, who are going to be sort of the saviors in the sovereign wealth category?
Well, their total asset books, they are a significant group of players, if you like. Their total assets are probably equal to private equity and hedge funds, probably greater. And more importantly, they are, on a long-term basis, growing much faster, double digits, although it's now more like 9-8%. And they will make a comeback when trade surpluses start increasing again and the global economy gets back on track. But in general, they're not as big, but they are cash rich. They are essentially debt-free funded. In these times, having a lot of cash is quite a valuable commodity. But they're not looking at banking stocks. They're selling where they can. We've seen Qatar and Abu Dhabi sell their stakes, and one wanting to sell a big stake, and they're looking elsewhere.
Well, who are those new sovereign wealth funds that will emerge? I mean, you've highlighted China's SWF as a real big leader here, CIC.
Yeah, absolutely. In the world of sovereign wealth funds connected to global imbalances, the Asians have preserved their surpluses on balance of payments much better than the oil producers so far, anyway. And China has an interest in a broad diversification of its broad sovereign balance sheet. And CIC is being primed as is at the top of the Christmas tree when it comes to Chinese state funds and state banks. It is at the top of the Christmas tree. It is orchestrating a big diversification out of China. It's affecting all sorts of markets. Emerging markets are particularly interesting for them because there's less resistance there when it comes to resources. But CIC is already requesting a near doubling of its capital from the State Council of China. And so we'll see a lot more of CIC in its investments. And they're much bolder and more aggressive than others. They're prepared to go back into the financial sector in the West. But they're also looking at resources, as the great resource rush is still very much on, led by China.
So the need for cash often changes the appetite and the willingness to sell to a sovereign wealth fund, right? I mean, that seems like an obvious point, but it's key to highlight because we did see at the height of the investment boom some unwillingness to allow sovereign wealth funds to take stakes in critically important or strategically important entities. What has changed over the past year that has perhaps made Western companies, Western governments more willing to allow those stakes? And now that they need that cash, how much is actually available?
Yeah, it is interesting that the Western government attitude and Western popular attitude has changed. They've been a little bit more accommodating towards the sovereign wealth funds simply because everyone needs investment now. We had that Sputnik moment back at the end of 2007 when we thought sovereign wealth funds were going to take over the world, and Western financial capitalism was creaking. But it wasn't going to be, and they weren't powerful enough to do so anyway. They didn't want to. And many of them got their fingers burnt and retreated. Some came in a bit later and made money.
All right, thank you so much, Jan Randolph of IHS Global Insight, highlighting particularly the Asian sovereign wealth funds as providing leadership in the year ahead.